Welcome to another episode of the Brightwell Podcast. My name is Tony Capucille, and I'm here with Trey, Raymer, my partner.
Good to be here.
Yeah. So today we're going to talk about, honestly, the basics of solar investing and renewable energy investing. Because I think, Trey, a lot of people don't know about it. It's kind of foreign.
That's right. Yeah. I mean, we're here to educate.
Yeah. So really what we hope at the end of this is you have an idea of why since 2006, so much money has gone into renewable energy investing, but maybe why you haven't heard about it. Because the initial folks that have used this have been public capital or institutional capital, kind of like insurance companies that say, man, these are great tax credits we're going to take advantage of.
Yeah, that's right. It's historically been for, much larger institutional capital, but we're here to change that.
So whenever I stop and look at investment, typically I'm looking at deploying capital and getting a return. But the reason that these solar projects are really attractive is because they have tax credits associated with them. They also have depreciation associated with them. But let's kind of break this down so that anyone can access what we're talking about. So let's start with the tax credits. That's kind of the headliner. Trey, talk a little bit about what a tax credit is to a layperson and why that's a really impactful thing for them in an investment.
Absolutely. So at the end of the year, if you're looking at your tax return from your business, your company, and you see, I've got a $1,000 tax liability, that's a check you're going to write to the U.S. government. If you had a $1,000 tax credit, suddenly you don't have to write any check.
Boom. It's just gone.
Yeah.
And that's why people always want tax credits. Tax credits are kind of like the, I don't know, what do you call it? You're going after the golden, what am I talking about? So tax credits are the coup de grace. What do we call them? Come on, y'all. What is a tax credit? It's I'm say it again. Tax credits are what people want.
Yes.
They want those more than depreciation. That's where we're going to start with that. We're going to stick with that because it's dollar for dollar. So like you said, if I have $1,000 I paid, I get $1,000 off if I have $1,000 tax credit. So it's the best thing you can get. Now, with solar tax credits, they're pretty aggressive. If I buy a project, I'm going to get a lot of tax credits. I'm going to talk about how you get those. You can get 30, 40, 50, 60 cents on the dollar, which is pretty significant. You put in $1 and you're going to get 60 cents back in tax credits. But the tax credits are interesting for solar because a lot of times when you get a tax credit, you have to use it the year you get it. So if you get a tax credit in year 26, it offsets 26 tax liability. Trey, talk to us about what's uniquely interesting about a solar tax credit.
Yeah, absolutely. So the most unique aspect of a solar tax credit is you can actually take it back, what's called carryback, for 3 years. That's very unusual from a tax credit perspective. And so you receive this tax credit this year, but you're unable to use it. You don't have the tax liability for it. You can actually go grab taxes that you paid for any of the previous 3 years and utilize that tax credit towards it. So suddenly you amend your previous return and you're getting a check back.
So this is really cool. So to use your $1,000 example, if I get $3,000 in tax credits this year, if it's a normal type of tax credit, I can only use 1,000 because it's all I owed.
That's right.
And so now I'm going to have to wait until 27 to use it and 28 to use it. And it's going to take me maybe 3 years. But with solar, it's unique in that, man, I use 1,000. I still have 2,000 left.
That's right.
And now I can look backwards.
Yes. So these solar tax credits, they're not refundable tax credits. So you can only utilize them to the extent you have tax liability. That would be different. So if it was a refundable tax credit and you received a 3,000 tax credit and you had 1,000 tax liability, you get a check for 2,000 from the government.
There's not many of those.
There's not many of those. Though.
Yeah, there's not many of those. But this is the next best thing.
This is the next best thing, yes.
And so I love it because it's the first time if you paid $1,000 each of the previous 3 years, and you're kind of like, I wish I would have mitigated my taxes better. And I don't know if it's a lot of our listeners or folks thinking about tax dollars, but whenever you can get that tax bill lower, you feel pretty good about it, right?
Oh, absolutely.
And so if you've missed in 23, 24, or 25, and you install a solar project in 26, and you have leftovers, you can actually go back. And talk about how at Brightwell, we can literally size it. We can pick a project for you to take advantage of all of your 26 tax liability. And then we ask you questions about, well, how much did you pay in 22, 23, 24, and 25? So we actually make a plan with you to formulate to go back and kind of sweep up all those other tax
Yeah, that's
credits.
the fun thing that we do out here. And those are the best conversations that we get to have with our impact investors is when they realize, oh my gosh, I can actually go back and recapture part of this check that I wrote to the government before. Most don't have any idea that's even possible.
Yeah, it feels really good to say, hey, federal government, we're going to work with you because it's their program to give me my taxes back through an amendment. It's actually not it's not a hard process.
No.
It's pretty simple.
Straightforward.
Okay, so that's the tax credit. And you mentioned impact investing. We're going to get to that in a second. But so with a solar project, to finish this off, if I have a $100,000 solar project and I put $100,000 in capital, either in cash or a loan, doesn't matter which that's important to note, and I have a 50% tax credit on this project, which there's a lot of rules around this. We're not going to get into the details, but a lot of ours have 40 or 50% tax credit. So if I put $100,000, Trey, how much in tax credits do I get back on a 50% tax credit?
$50,000 right off the top.
$50,000 right back to my bottom line. So really, I'm only putting $50,000 into the solar project. So that's how cool. And these tax credits, not only can they carry back 3 years, Trey, they can also carry forward
20 years. Yeah.
20 years. So you literally have a flexible asset there. All right, that's the first of 3 components of solar investing. Why people are so excited. If it stopped there, honestly, people would do it. But we got another big win this year with the Big Beautiful Bill. And that win is 100% bonus depreciation. So 100% bonus depreciation is unique. It's a little bit different than a tax credit, but still very cool. So just explain to our listeners what bonus depreciation is generally.
Yeah. First, I'll just start with the concept of what is depreciation generally.
Yeah.
So the purpose of depreciation from a tax code perspective is I'm a business owner. I make a capital investment. This capital investment is going to last for 40 years. Well, the tax code, in most typical situations, would say, all right, well, you can actually take depreciation credit, which goes up against your ultimate taxes at the end of the day over the life of that asset. So if it's a 40-year asset, it may be 40 years that you're depreciating it over. The beautiful thing about 100% bonus depreciation and what got put in place with the One Big Beautiful Bill Act is that for many assets now, including solar projects, you're allowed to take on 100% of that depreciation in year one.
So this is beautiful. And let's just apply it generally. If I get $100,000, and don't worry about the tax credit portion of it. We'll talk about that in a second. But if I have $100,000 and I spend that on my solar project or on an asset, and I can depreciate that 100%, and I pay 37% federal tax rate. Let's just keep it simple, 37%. So talk to me about how much I would save in my tax bill. I put $100,000 up, and I pay 37% federal tax if I was getting the 100%.
Yeah, so that's $37,000 of tax benefit that you're receiving year one under the 100% bonus depreciation.
Okay. That's important.
And that's just federal as well.
That's just federal, and obviously state. And if you're in Oklahoma, you're 4.75. You're 13.3 in California. We're sorry for our California listeners. If you're in Texas, you're at 0. We get there's differences. There's nuances to everyone's tax bill. So we actually, unlike the tax credit, it's just dollar for dollar, pound for pound. We actually have to know your federal and your state effective tax rates to calculate depreciation. But fundamentally, if I got 50 cents on the dollar on that $100,000, I got $50,000 for the tax credit. And now I'm going to get another chunk of change on the depreciation. So if you think about this, I'm getting north of 70% of my project paid for via dollars I otherwise, Trey, was just sending to the federal government, right?
That's absolutely right.
Now, we have to make one adjustment because solar does get a 100% bonus, which is incredible. That's new as of July 4th, 2025. It's going to carry forward indefinitely. It makes solar investing even that much better. There's one small caveat that you can only get half of your tax credit. So let's use that 50% example. If I'm getting 50% tax credit, you would actually think you can only bonus depreciate half of it. So like if I put $100,000 in, I'm getting $50,000 back from the federal government. I've actually only put in $50,000, right? But the crazy thing is you can depreciate half of that. So you can just give a little bit of clarity on that because it's an important piece of the puzzle.
Yeah, it's a good point. So it's a nuance, and we won't want to oversimplify it, but effectively, whatever that investment tax credit you're receiving, so if it's 50% in this example, you've got to back out half of that.
So you still get to depreciate.
You still get
half of something you didn't even pay for.
Right.
Like that's like it's a cool gift in this situation. So if I'm getting 50%, I can bonus depreciate $75,000 against my effective tax rate. So, all right. So those are the two main aspects of tax investing. So when you're investing in a normal investment, maybe the stock market, maybe just of course some real estate has tax advantages, but when you're investing in a normal investment, you're not thinking, man, I'm getting tax credits. Man, I'm getting bonus depreciation. Those are typically reserved for historic projects or low income projects or projects you can't get into, right? So you're actually getting into something that is different. It's tax equity investment. And I'm going to pause here because if I'm going to pay for $100,000 project, Trey, and 70,000 of that is dollars I would have otherwise spent writing to the IRS, either through withholdings or quarterly checks, like that's not accessible money to invest. Like talk about that. It's not like, oh, what else could I put my money in? A tax equity investment unlocks a pool of dollars that otherwise has been inaccessible to the normal investor.
Yeah, you said it very well. I mean, at the end of the day, the government has incentivized this behavior. That's what the tax code is. It's putting government in place to incentivize us to do certain things they want us to do. They have put this in place because they want to incentivize this type of investing. So absolutely, it's there to be utilized.
And I would say the most interesting part about it is that $70,000 was just gone, and now you have agency. Mm-hmm. And I think that's also why, yeah, you can make money on that dollar. And that's important to be able to now invest a pool of money. And it's funny. Sometimes people think, and I think, I work all the way to April or maybe May, or if I'm in California, maybe June. And that money's going to the federal government or the state government. And then I start getting to make my income. You can take that tax dollar back and now use it to make a return, but also make an impact. And it's giving people agency to do something with their tax dollars that they've previously not had access to. That's actually what's so interesting about solar dollars. And we're really glad to bring it from the public and institutional level down to somebody that's just a normal taxpayer, right?
This is allowing you to redirect where that money is going to. Is it going to go to the black hole of the federal government, or is it going to go to a certain thing that you care about?
Yeah,
that's your choice.
That's the agency you're getting. And so let's talk real quick about the third component, and then we'll bring it home kind of holistically about the investment. So we got the tax credit, dollar for dollar. We got bonus depreciation on everything about half of the tax credit. Now we have the income stream. This is the cool part. Solar, obviously, is producing energy for underlying organizations. In our situation at Brightwell, it's for nonprofits, churches, schools, food shelters, you name it. So these organizations have been paying an energy bill to their utility provider. Typically a monopoly, they don't have a lot of choices. So we're actually walking in and negotiating what we call a service agreement, an energy management service agreement. That's going to be income. And that's the third leg of our Brightwell stool, that as an investor, you're getting income now on a quarterly basis back, and they're paying you instead of the utility company. And that's a huge deal because, it's already fixed into their budget. It's a predictable income stream. And, Trey, we can do anywhere as short as essentially 6 years up to a 20, 25 year kind of income stream. So talk about that last piece and why it's a really cool part about solar investing.
Right. And the beautiful thing about, with the Brightwell project is that everybody wins in this scenario. So when we talk about the organization that's entering into this with you has this ever increasing liability to pay for their energy.
No organization we know is like, I'm really excited to pay for my energy bill. That says no one ever.
There's no one ever. And those prices are going up, are skyrocketing right now. And we're bringing them an ability to hedge that, to lock that in, to give them that control back, that agency back. So they're winning. The impact investor that's coming into this arrangement is winning because not only do they get those tax incentives, but there's also this income stream that comes in. But to an organization, when they put that in, they can see that what they're going to be paying for this is, less than they would otherwise be expecting to pay to their local utility.
And so these arrangements, third-party ownership for solar projects, have been done since 2006. So this convention is not new. The new part about it is Brightwell structures win-win contracts with these organizations. So a lot of folks that did third-party ownership actually charge the organization more sometimes, and kind of punitive rate. They're not always structured for the organization to win. We structure them really fairly, and we take all of the middle money out, all the transferability out. We just say an investor owns a solar project on the zoo. The zoo wins, the investor wins. Any question? I mean, it's kind of that simple. Right. Mm-hmm. And so, like, whenever we're thinking about an investor, if you're saying, man, how do I qualify? How do I know if I'm a fit for this? Well, if you pay taxes, and we say if you pay around $250,000 in taxes a year, you're going to be great. You're going to be great. And whether you're paying through withholdings, if you're a W-2 employee, or if you're paying quarterlies, you're going to be great. But that is an interesting part. If someone's listening and they're a physician, they're an executive at a publicly traded company, they are making W-2 salary, ordinary income, they've typically not thought they can access something like this because how can I write something off? But we're in a unique position in which we can offer those folks something interesting.
Yeah, we are. Absolutely. So we can offset both your active tax liability as well as your passive tax liability. That's unique, the setup that we offer. And for someone that's paying quarterlies, what effectively they're doing is they're trying to estimate what their tax liability would be for the year. And so if you're able to make this decision early enough in the process, then you don't have to write that check because you can then estimate what your liability will be. And that's a nice feeling.
It's a huge feeling. So yeah, I would say if you're a person listening to this podcast and you pay around $250,000 a year in taxes, or have paid that for the past 3 years, or planning on paying in the future, pause. Like, you could do something better with your tax dollars. You can get tax credits, you can get bonus depreciation, no matter what your scenario, active, passive, or both, right?
Right.
And then you can get an income stream. And you can plan, do you want all that income stream up front so that you can effectively get your money back right away? Or do you kind of want an ongoing passive income stream for 10, 15, 20 years? I mean, that's kind of summarizes why it's so cool. You're taking something you otherwise had to pay, turning it into something that is creating income and wealth. But we almost have not talked about the biggest part, which is also the impact.
Oh, yes.
So you're doing this thing. It's magic on the tax side, magic on your income side, but boom, bring us home, Trey. Why is Brightwell so unique?
Yeah. I mean, our trademark is unlock generosity. And it's that way because by unlocking these tax incentives, we're allowing you to make this gift effectively to a nonprofit organization, which could be in the hundreds of thousands, millions plus, benefit over the 30-year life of this system, which is just incredible. So you're able, it's a win for the impact investor, a win for the organization, a win for all involved. That's why we're doing this. This is not a way to take advantage of organizations. It's a way to make that lasting impact.
And it's why organizations love using Brightwell, because they come in, we're advocating for them, we're creating win-wins. Our investors are clearly taking a very sophisticated strategy. Your CPA is going to love it. Your RIA, your tax lawyer, they're going to say, this is an incredible use of tax dollars. Yes, you will build some wealth. Yes, you will do something really cool. Yes, you will make an impact. And the combination of them all, just check out solar tax investing through Brightwell. And it's fun, it's different, and you'll feel like you have agency for the first time ever in every tax dollar where it goes.